All right, hey, welcome to our week. And in this week, we are going to be talking about output analysis. And I have some work already started here, but I wanted to back up and do a little bit of review. Remember in our last section, we talked about input analysis, and we kind of had this idea of a chart where we were looking at some input that we made a decision to use. And one of the common examples was that we were looking at fertilizer, that being R there, fertilizer, that we would use in our corn production to get us bushels of corn as our product. And we talked about how in input analysis that you had a beginning spot here where you increased at an increasing rate, meaning the fertilizer really was making a difference. That point of inflection then caused us to see an increase in corn production, but not at the same rate, and then it peaks at some point. You put so much fertilizer on that corn production doesn't increase anymore, it actually decreases. And we call that total physical product. That is quantity of production. Now, that's kind of what we had before. This point of inflection was a spot. This diminishing returns was an important spot, and we did some average analysis and marginal analysis. Now, marginal analysis, if I put it on the same graph, it increased, of course, as we're increasing production. But then here, it actually decreases. Marginal physical product is what that's called. It drops to zero when we have negative production. So that's not a smart area to be in. Point of inflection is interesting. It's really early in the production process. And the problem is that yield is way from where it could actually get to. And if we're a farmer, we get paid to sell products. Selling a low quantity is not going to help us out at all, because we're going to sell that low quantity while someone else produces the higher quantity. We won't make enough revenue to exist on. But we looked at average physical product, which peaks after the point of inflection. Usually when it runs into it, it levels off, and that was called average physical product. Well, in our last class period, draw some extra on here, in that last section that we talked about, we said that average physical product and marginal physical product, when those meet, if I can get some ink here, but when those meet in our curve, if I can get, there we go. When those meet, we end up with a new intersection right here. And we called that stage 2 of production. This stage 2 of production differentiates. Stage 1's back here. Remember, that's an entry stage. Stage 3 is this area here, and that is an exit stage, meaning you're not in good shape there. You must be getting out. So stage 2 is really where it's at, and that's this idea of where profit should be found. And so what that does is starts to let us know from an input analysis, at least on one input, so just the one that we're talking about here, fertilizer in this case. This one input has lots of different places or levels we could use. The low level of fertilizer is going to get me low production. Extreme high levels of fertilizer is not going to get me high production. In fact, it's going to get me negative production. This is your target or goal as far as use of fertilizer goes. And if you can get all your inputs to land right in that spot, then we end up with potentially being able to find maximum profit here in stage 2. Now that's input analysis. We talked a lot about how you figure out if you're profitable or not. But now I want to talk about output analysis. So what I'm doing is I'm taking this bushels of corn concept, and I am looking at that as total physical product, and that is the quantity right here. It's total physical product. That's our quantity. So in output analysis, we go ahead and look at the production of, I'm going to say, to keep it simple, 10 units all the way to 70 units of output. All of this is very much likely stage 2 area. All right, so I'm not looking at 0 anymore because that's way back at the beginning. And I'm not looking at the quantity to drop because that was something we called stage 3. That's no good to us as well. So when we do output analysis, we focus on stage 2 quantities of output. And then we start to talk about all inputs. We're not talking about just fertilizer. We're talking about all inputs. So in this case, I am able to look at output analysis, just the quantity, and then I start to bring in some new things. Let's talk about those. And I'm not looking at the details anymore of fertilizer. I'm looking at all the inputs like fertilizer, like insecticide, herbicide, tractor time in the field, maybe certain other growth inhibitors to increase production. All of these things, seed, all of these things are inputs that I would choose, and this case was only one. Now I'm looking at them all. When I talk about inputs, there's really two, or I say inputs. Those cost me money, and that's called an expense. Expenses are divided into two categories. So when we do output analysis, we get a chance to focus on those expense categories, and I want to go over them with you here. Now, I've already got a table started to get me moving along, but we're going to calculate some of those values here in just a bit. But let's talk about first the cost. What is this cost called? TFC. That stands for total fixed cost. Now, total fixed costs are also used another word that's called sunk cost. Because when you look at expenses to go from 10 to 20 to 30 to 40, whether you decide to produce 10 or all the way to 70, you're going to end up with a flat cost value, and they're called fixed cost. Another word, again, is sunk. Now, these costs, sunk or fixed costs, are things like maybe insurance for our property. Maybe it's going to be depreciation for our equipment. Maybe it's going to be management expenses to run our operation. Whether we produce a low amount or high amount, these are the costs that we have, and they're called fixed. And in fact, looking at my variables here, I've got 10, 20, 30, 40. No matter what I do, I have $80 at each level. So I just kind of put that down, but you would still have $80 here, $80 here, $80 here. You get the idea. It does not change as we go. That is called a fixed cost. All right, let's go to the next kind of cost. It's the ones we've been looking at. These are called variable cost. And variable costs are, just like we talked about, they're going to vary. And these are the ones that we did input analysis on. These are our inputs that we've already talked about. So variable costs would be things like fertilizer, insecticide, herbicide. If you're going to try to get 10 units of production, let's just say, in this case it's corn, which doesn't make sense at 10 bushels, but let's just say units. Maybe these are larger collections of these bushels. But anyway, 10 units, 20, 30, 40 to keep it simple. These are going to be based on a number of inputs that I made decisions on that kept me in stage 2, and this is the total of all those expenses. I've already created them for you here to move us along. $43 is the cost, $55, $65, $85, $120, $169, and $270. And I should have said in the very beginning, taking notes along with me might help. So as you build your quantity, 10, 20, 30, 40, 50, 60, 70, $80 all the way down, and then these are our costs here. You may want to freeze the video and get your tables built. But these are variable costs, and as we produce more, we typically have higher cost. And that is, again, what you'll see in stage 2. Now, not higher individual costs, but just higher total cost. So this is total variable cost, total fixed cost. All right, now if we move across here, we would just simply add these together. And so total cost, total fixed cost plus total variable cost equals total costs. So I'm going to go ahead and look at these. These are 123, 135, 145, 165, 200, 249, and 350 as we move across. All right, now that's the cost world. They're divided into two types, fixed and variable, and I've laid these out here and what they are as far as information from previous that we've worked at, or just flat fixed costs that we have talked about. Sunk cost is the term. All right, let's move across. What about this next column I have here? Total revenue. Well, if you sell 10 units of something worth $5, then you're looking at a $50 total revenue. If you sell 20 units of that same thing, you are looking at a $100 total revenue. And then you see what happens as we go through. That would be 150, that would be 200, that would be 250, that would be 300, and finally that would be 350. Those are our total revenues. And I see something here that I want to change a bit. I want to talk with you about a simpler term here at first, so let me get rid of that. And that is going to be this term of profit. And so I'm not looking at any analysis right now, but just simple profit. So if I take a look at my notes here, pull these up, make sure I get this profit correct. Now, profit is revenue minus cost. So when we come across here and look, profit, and I should draw up here that profit is going to be our revenue minus our cost. And so that is our formula for profit. So if we look at revenue, we're only making 50 bucks. Take it away from 123, and we are losing, it looks like, $73 here in our profit column. So you could say that if you're at 10 units of production, you're going to lose $73 here. That's not going to work. We need to shoot for something higher. Now notice we're not building from stage to stage. When we did input analysis, and we're going to do it here too, but when we did input analysis, we looked at the change of each stage. So don't let this confuse you. We are talking here about total. So if I've got 10 units of production and that's my target, I'm going to lose $73 per whatever this whole thing's based on. So at 20, it's going to be a little better. I have more revenue, but it looks like I still lose $35 based on 100 minus 135. Now finally, when I get to 150 or 30 units, I'm making $150, but my cost is only $145. So finally, I'm making a profit of $5 if I'm at that stage. And then if I keep moving through here, I move from 200 to 135, I'm making a profit of $35 through here, and I'm going to leave the pluses off. As I keep moving through here, I'm looking at $50 in profit, and as I keep moving through here at the next level, I'm 300 minus this, so I'm $51 in profit. And then if I move to the next level, I am $350 in revenue minus $350 in cost. I am $0 here, so there's no profit made. So in output analysis, we are looking at a quantity of production, cost broken down into usually these categories of fixed and variable, gives you a total. Looking at revenue, it's what do I sell this for and how much is that going to give me? And then it's a simple revenue minus cost to look at profit. If we are looking at where we should be targeting, you can see that 60 units of production, which is going to get me the most profit per unit that I'm looking at, not per unit, but per business model here, then I'm looking at $51 in profit. That is going to be your target and what you go after. Now, in this beginning of output analysis, we're just simply looking at total value. However, in the chapter in this week, we're also taking this to the next level and looking at this cost from a new standpoint as well as the revenue. And that's called marginal analysis. Remember, marginal analysis, let me write it down. Marginal analysis looks at the change. That's the focus. And so when it comes to marginal cost, it's pretty easy. It's going to be the change in our total cost divided by the change in our quantity of production. Marginal revenue would be the same idea, except we're talking about the change in total revenue divided by the change in the quantity that we produce. So those are two formulas here to make sure that you have, except this one, I'm going to move it over a little bit. Every time I sell one more set of units, so let's take our example right here to keep it simple. I move this up by 10 units of production. That's the change in my quantity. If I come over here and look, my revenue went up by $50. So the change in revenue is 50 divided by the change in quantity, which is 10. That's $5. Marginal revenue is always equaled to the price of the product. There is no really thing to calculate here. So this is really what marginal revenue always is. It's always the price of your product. So like we did input analysis, we looked at marginal value product, marginal input cost, different discussion, one input at a time. But when we move to output analysis, we apply the same concept. Marginal cost is going to change every time we go from 10 to 20 or to 30 to 40. You are looking at 10 units every time. But your costs are going to change. They're not consistent like revenue, because revenue is the price of the product. Quantity of production and the cost values change, mainly because input analysis. Input analysis tells us these variables are going to change, so variable cost is going to alter itself. It's going to go up every time we try to produce more, but it's going to change at a different rate. So marginal cost is something you're going to calculate, and you're going to compare that to marginal revenue. And that is something gone over in this chapter in this week. So I want you to make sure you look at the notes, and hopefully calculating this table and understanding these formulas might help you work your way through the notes and complete the homework that we have this week. So make sure you take a look online, and hopefully this video, again, going over the chapter that's also online this week, helps you get through the topic. Thanks.